This isn't really a story about predicting the future. It's about something much more methodical. It's the story of a diagnosis. A doctor who looked at a financial system everyone thought was in perfect health and found a sickness hiding right there in plain sight.
It all started with one simple but really powerful question. While the whole world was chasing growth, chasing profits, one analyst stepped back and asked something different. What if the very foundation of all this is flawed? And that one question, well, it would lead to one of the most famous trades in all of financial history.
So here's the conflict. On one side, you have the entire financial industry. I mean everyone, operating on this core belief that U.S. housing was as safe as it gets, a rock-solid asset. But on the other side, you have this doctor's mindset. And a doctor doesn't just assume a patient is healthy, they look for what could possibly go wrong. That's exactly where our story gets interesting.
Okay, so to understand how somebody could see what an entire industry missed, we have to look at where he came from. Michael Burry's approach wasn't developed on a trading floor. No, it was shaped in the very disciplined, very analytical world of medicine.
Burry's early life really shaped his perspective. He became very inward-looking, very analytical. He went on to pursue this incredibly demanding career in neurology, a field that's all about recognizing complex patterns. But at night, he had this other obsession. He would pore over financial reports, and he applied that exact same diagnostic way of thinking to company balance sheets instead of brain scans.
And this right here, this is his whole philosophy in a nutshell. He started to believe that markets, a lot like people, don't just collapse out of nowhere. They show symptoms first. They show signs of stress, of sickness, long before the real crisis hits. The trick was just knowing how to spot those signs.
So with this unique point of view, Burry turned his full attention to the U.S. housing market in the early 2000s, which was absolutely booming. But he wasn't looking at the happy headlines. He was searching for those underlying symptoms.
Now, this is a really important difference in process. You see, the big banks, the rating agencies, they'd see a AAA rating, and that was good enough. It was a stamp of approval, a shortcut. Burry, though, he ignored the summary completely. He went straight to the source, reading these dense, 100-plus page legal documents that spelled out exactly what was inside these mortgage bonds. And what did he find buried in all that fine print? The first major symptom? Tons and tons of subprime mortgages. These were not your standard safe home loans. No, they were given to people with shaky credit, and a lot of them had a sort of ticking time bomb built in. These low teaser interest rates that were designed to jump way up after just a couple of years.
So once he saw the disease, he had to find the right treatment. And in this case, the treatment was a financial tool. He found something called a credit default swap. The easiest way to think about it is just like an insurance policy. You pay a regular fee, a premium, and if the specific bond that you're insuring fails, that policy pays out.
This is the most crucial part of his whole diagnosis. It was subtle, but it was absolutely devastating. The system didn't even need a massive housing price crash to completely fall apart. All that had to happen was for prices to stop climbing so fast. That's it. The moment that happened, people couldn't refinance their loans, those teaser rates would kick in, defaults would start, and the whole house of cards would come tumbling down.
So he'd made the diagnosis and he'd found the treatment. Now came the hard part, actually administering it. And this is where his deep analysis met a very, very painful reality. The success of this whole thing wasn't just about being smart. It was about pure psychological endurance.
It sounds simple enough. He used his fund's money to buy these credit default swaps on the mortgage bonds that his research showed were the absolute weakest. But, and this is a big but, he had to keep paying those insurance premiums, month after month, year after year, just waiting for his diagnosis to be proven right.
He put the trade on in 2005. But all through 2006, the housing market just kept going up. Can you just imagine the pressure? On paper, his fund was bleeding money every single month from paying those premiums. His own investors, seeing losses while everyone else was making money, got angry. They started demanding their money back.
This quote, it just captures the feeling of that time perfectly. Think about it. Every market indicator, every news headline, every angry email from an investor was screaming at him that he was wrong. Only his own data, his own deep research told him he was right. To hold on to a belief when the entire world is against you, that is an incredibly lonely place to be.
But here's the thing about a conviction that's built on hard data instead of just opinion. It has a certain power. And after years of waiting, the symptoms he had diagnosed finally started to show up in the real world.
In early 2007, you started to see the first little tracks. As those teaser rates started to reset, just like he knew they would, mortgage delinquencies began to tick up. It started slow. Then it picked up speed, and by the end of 2007, the numbers were just exploding. The data was finally catching up with reality.
So as the bonds started to fail, those insurance policies, the credit default swaps, their value went through the roof. That slow, painful bleed of paying premiums turned into a massive flood of profit. For the investors who stuck it out, the final result was a profit of more than $700 million.
This wasn't some kind of victory party. There was no celebration. You know, when a doctor confirms a diagnosis that their patient is terminally ill, it's a very solemn moment. Burry just watched the financial system start to unravel just as his research said it would, and he simply, quietly, closed out his trades.
So what's the real wisdom we can take from this? Because it's not about trying to get rich by timing a market crash. It's about the principles of analysis, of risk, and of discipline that this whole story teaches us.
The lessons here are just timeless. First, doing your own deep homework always beats just listening to someone else's opinion. Second, preparing for what could go wrong is so much more important than trying to guess what will go right. Third, the ability to handle that psychological pressure, that's a real advantage. And last, being different just for the sake of being different is useless. Being a contrarian without the data to back it up is just another form of gambling.
And really, this all comes down to a fundamental choice for any of us as investors. Most people are busy chasing certainty, trying to predict the next big thing. The wiser path, as this story clearly shows, is to focus on understanding and respecting risk. Real success often comes from avoiding that one catastrophic loss, not from finding the one huge winner.
And this is the thought I'd like to leave you with. A lot of very intelligent people lost absolutely everything in 2008. The people who survived and even did well weren't always the smartest in the room. They were the most disciplined. They had a process. They respected risk, and they had the emotional strength to stick with it.